Okay, welcome back. So we're saying we're going to resume on what group earnings. So I'd say that the working is such that, okay, this is working 6 now. Okay, that you bring all the retained earnings of the parent. Okay, and these are usually given in the statement of financial position. Okay, for the parent, just come and get the figures. So we're given retained earnings at the start of the year and the profit that they made during the year. So giving us the closing, which is 63 to 60. Then we're saying that any adjustments that are affecting the profit directly of the parent must be deducted. So that's why you're saying the analyzed profit was on the parent. So we come and remove it strictly here. So what else do we do? Now, the next thing is you bring now the share. Yeah, share of the subsidiary. In this case, it is post-acquisition profits. Okay. Now, where do you get that from? This one is from working number 2, the summary table number 2. Okay. And begin, you're interested only in the profit, so you're interested in the retained earnings only. Okay. If there's any movement elsewhere, don't assume that it goes to profit or loss or group retained earnings. No. So the good thing is that the movement in this case was only on retained earnings, so you bring the entire 4,000. Yeah. Yeah. So we come and show the share. Okay. It is 75%. So you say 75% is what you have in control of the 4,000. That's what you have as your profit. Then what else? We don't have anything else. Yeah. So we are done with group retained earnings. If there was any impairment of goodwill, we would include it. Yeah. So, but there's nothing like that. So just add. That will be our group retained earnings. If there was anything like extra depreciation, if the excess was on a depreciable asset, then you bring it here, extra depreciation. But we didn't have it, so well and good. Now you go to the last working, which is working number 7. Non-controlling interest, where people are interested. Now, non-controlling interest refers to the interest that the minority shareholders have in the subsidiary. That when you come and buy shares in a subsidiary or in any company, and you're taking over 75%, like it is in this case, over 75%, there's a 25% remaining somewhere. That 25% is what you're calling the minority shares. That's what you're calling the non-controlling interest. That you also still compete for that because they also own shares. So what falls under non-controlling interest? I think David was asking about the non-controlling interest. Okay, what falls here is the fair value of the non-controlling interest. This figure. And usually this one here is given in the working. Okay, not in the working, but in case it's not given in the additional information like it was this time, you have to work it out. And this will be under working number 3, the goodwill thing. So what was the figure? I think it was 9,000. This one was given. Goodwill. Fair value of non-controlling interest, this one, 9,000. So you come and bring the 9,000 here. Is the share of the profit. Okay, S is subsidiaries post profit. So take a share of that. Okay, and this one is from working number 2. We're saying 25% of the profit, 4,000. Then what else would affect the NCI is if the subsidiary is the one that had, and there were some goods left unsold with the parent, then the unrealized profit would come here. Okay, although not entirely, it only brings its portion, which is about 25% only. Then the remainder would still go to the parent. Okay, that's how to be different. So unless if there was impairment also, but for impairment, since Frank is setting a paper, it's going to still remain like this, fair value. And for fair value, the parent NCI does not suffer impairment. The impairment is suffered by the parent only. Okay, hence we add this. Okay, and you have 10,000 for NCI. Okay, so once you're done with your workings, you now go to your statement of financial position and begin moving the items. So we're done with additional information. That's where the hurdle is. Then you come and start now consolidating line by line. Just move from up downwards. So non-current assets. So someone's saying, pardon me, on marking number 6. Marking number 6, we said is what? Is it group? Group line earnings. All the profits of the parent. Okay, they are given in the question. Let me refer to the question. Yeah. Okay. H is the retained earnings. They say that they had it at the beginning of the year as 51 to 60. So the total retained earnings, therefore, you add that way to get the retained earnings at the end of the year. And that's what reflects the year side. So having shown the parent's retained earnings, a direct transaction, yes, the unrealized profit, okay, on the sold goods of 160, you come and deduct it straight and there and then of the subsidiaries post-acquisition profits, okay? Profits that you made after acquiring the assets are shared between, so it was 4,000, so we're getting our share, which is 75%, and we get the figure. And then you add, okay? So I hope I've answered you, Avasa. Working 5. Working 5, we said, in the question, it is clear they're saying that, I want to refer to it again. So just take note that we debited payables and credited receivables. And the reason is they say that the additional information here that included in the respective accounts, meaning the assets and liabilities, we have what they call current accounts. If you remember branch accounts in intermediate, we had what they call current accounts. Okay, this is where you have intercompany companies or related companies trading with each other. So usually they hold special accounts in each of their books to reflect any balances or any transactions happening within the respective accounts. So in short, this information means that in the parents' books, they had the current account showing 5,000. Then in the subsidiaries book, also they had a current account showing 5,000. And I'm saying, if one company has an asset, the other must have a liability. Okay, it can't be the other way around. So unless there were any other thing like not intercompany, but transactions in transit. If there are transactions in transit, then these balances will differ accordingly. You find that the parent's current account is showing 5,000, then for the subsidiary showing 4,000 because of transactions in transit. So we didn't have anything like that. So I'm saying these were balances. So if somebody has a payable 5,000, the other will have a receivable of 5,000. But for consolidation, we say that there's no chance that okay, there's no chance that the parent demands the other, then subsidiary demands the other. You can't demand yourself. Okay, we say group accounts, you're one, so you can't demand each other. So because of that, we just cancel the dates or the transaction. Yeah, hence removing the payable and removing the receivable. That is working number 5, Sumaya. So back to our consolidation now, officially. We are wrapping up. I want to finish like with this thing. So kindly, where did you remove all of H? Where did I get it from? It's from this thing here. Retained earnings for H. This is H's book. So this one, the first 2 columns are for H, then the next 2 are for S. So retained earnings, they say that at 1st October 2013, that's the beginning of the year, you had 51 to 60. Then they said for the year, keyword is for the year, meaning that what happened between the year, they had a 12,000 and it's positive, hence profit. So you add the 2 to get the retained earnings at the end of the year. Yeah, so that's why you're adding the 2. I hope I've answered you. I think. So let's continue. Non-current assets. I'm not going to respond to chats now. Okay, for purposes of time. Okay, so when you come to this non-current assets, okay, maybe the thing is, I'm just going to show you the question. Since you'll have the question, let me just show you the working. Yeah, the working, then I will not be showing you the question again until maybe you're not sure where the figure is coming from. Then I can share. Okay, so otherwise, I have non-current assets. Okay, PPE. Just adding. You have 78,690. Then 27,180. Okay, we didn't have any adjustment. I think we had only one, the one of land. So we have land, which is valued at 4,000 here in working number 2. So it's plus 4,000. Okay. Then shall I see the total? Then we go to the next item, which is investment. Okay. Investment in a parent, we saw it is 4,800. So the investment disappears and it's replaced by the goodwill that you got. Yeah. So intangible assets. Then you have goodwill. It was working number 3. The figure was number 3. Figure was 9,050. Okay, then you go to the next item. The next item is current assets and inventory starting. Okay. Inventory for the parent, it was 7,450. Then you add the inventory for the subsidiary, which is 4,310. Then you deduct the unrealized profit, 160. Then you go to the next item, accounts receivable. Okay. Just receivable. Receivable for the parent, it was 12,960. Then you add for the subsidiary, which is 4,330. 4,330. They said we had a 5,000 balance that they're trying to remove, which you have removed now from our working number 5. Then you have a cash and bank. Cash and bank. Cash, bank. Okay. The parent has nothing, but the subsidiary has 520. So 0 plus 520. Have any adjustments regarding that? 520. Then we have we go to equity. So under equity, you have ordinary shares. For ordinary shares, you only bring for the parent. Okay. And the parent were 20,000. 20,000. But remember, from our working number 3, that transaction of issue of shares was not recorded. So we have a 10,000 affecting ordinary shares. So you bring it there. Then you have a share premium. You still bring only for the parent. Share premium. Okay, We didn't have any adjustment when working for it. So just bring only the figure that is there. And for the parent, we had the 10,000 as the opening balance. And now we also had an extra 10 that when we issued the 10 shares. So 10,000 plus 10,000. Okay. Then we have retained earnings. Retained earnings, just bring the one for the parent, I mean for the group that we computed, which was working number 6, I think. Okay. Bring the figure. Number 6. It was 66,100. Then you now have a non-controlling interest, which is working number 7. It's also part of equity. What we say, the other shares, the other shares relating to the minority, which is 10,000. Okay, and by doing that, you're done with all this equity. Then you go to liabilities. Have non-current liabilities. Non-current liabilities. Okay, for non-current liabilities, we have loan notes, 8%, 6,000. Loan notes. The parent didn't have anything, but the subsidiary had 6,000. Then you have accounts receivable for current liabilities. Current liabilities. Have payables. You bring the parents' accounts payable is 5,920. Then subsidiary is 4,160. But remember, we are removing a 5,000 from mark number 5. Then bank overdraft. Bank overdraft. The parent has 1,700, but the subsidiary doesn't have anything. Then you have a provision for tax. Tax provision. They both had. Parent is 3,070. Subsidiary is 2,180. And then we are done. Okay. So I'm just going to add and finish. Okay. So otherwise, don't have anything. If there are any questions you have to ask, I think let me see what someone is saying in the chat. Could you please share the workings? Okay, wait, so somebody just commenting. Yeah, I usually share the workings in the group. Okay, I usually share them, so you will surely see them. Otherwise, we are adding here. So when I get the totals here, okay, so what they have for, that is for non-current assets. When I add, that's what you get for non-current assets as the total. Then you have current assets. Okay, current assets. Inventory. I have that 16. Then receivables. That. And for cash, I think it's just 520. So when I add total assets, I have 1,148. These are total assets. And when we come to equity, this is 30,000. one is 20,000 ordinary shares. Then find earnings are 16. Then yeah. Then when I add equity alone, I have 1, 2, 6. This is total equity. We bring our liabilities, this is 6,000. And for payables, have that. Then for the overdraft is 1,000. Then for provision, you have that. Then you add all equity plus liabilities. Okay, you get 149. Okay, there's a difference. I don't know where it's coming from. But yeah, this is total equity and liabilities. Liabilities. Okay, here's what I forgot. This minus that. I have 800. Where do you have the 800? Contingency. Contingent asset, I forgot to bring it. Contingent asset, the current asset, you bring it here. Contingent asset. Contingent asset. This is from working to. It was 800. So, and you have your balance sheet. Okay, so unless you have any questions now, I beg to stop here. I don't know that I shall have another discussion under for group accounts. You know how tight the whole thing is.